As a dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you. Welcome to the Dr. Josh Cochran Show. We have a fun show today. Wealth, health, family, freedom. This show's for dentists, doctors, and business owners. It's brought to you by Cochran Capital, a thoughtfully designed investment portfolios for accelerated wealth building, sophisticated strategies to defer or eliminate capital gains, depreciation recapture, and ordinary income taxes. Build the future you deserve. Just a heads up, everything we talk about on this podcast is just our personal opinions and experiences. We're not giving legal, financial, tax, or accounting advice, so don't take it that way. Be sure to talk to a qualified pro before making any big decisions. We're just here to share ideas, have real conversations, and hopefully help you think a little differently. First part of our show today, we're just going to talk a little bit about the news and then dive into Investment Corner with our special guest, Yanni Perez. So in the news, very briefly, Scott Bessent, the head of the Treasury, is continuing to execute his goals. One is bringing down Treasury yields. You know, the government owes over 30 trillion. And so as they bring down Treasury yields, they can refinance their debt at a much lower interest rate. So we'll save the taxpayers a lot of money. So that's like that's one of the primary goals. The other one is deregulating. And so this week, we're seeing a ton of deregulation happening. Specifically, one area for real estate investment is HUD. So HUD does a lot of, it's the granddaddy of loans, the HUD. They have some great refinance loans, some great construction loans. And HUD is making it easier and easier. Let's say you build like an apartment building and you want to cash out as much as possible, and you don't want a variable rate loan. You want a low rate, long-term, like 35-year fixed rate, and cash out 80% of the value. So you can get like all your money back or more and still own the property. So HUD is continuing to deregulate and make things a lot easier for investors. So pretty cool. Okay, so investment corner today, we have Yanni Perez from Florida. Yanni, you want to just tell your story a little bit, allow people to get to know you a little?
Yes, thank you for having me here, Josh.
That's my
So
pleasure.
my name is Yanni Perez. I'm a general dentist in West Palm Beach, Florida. I actually reached out to Josh because he talked about opportunity zoning in one of the Facebook groups. And I was curious because I've never heard of that before. And I went in online to their website, Opportunity Zoning, and I found out that I actually own land in that area. And then I just started Googling more information about it, and then hopefully in this podcast we find out more information. Actually, I'm in the process of selling my practice and relocating to the other coast of Florida, to Southwest, and I just wasn't sure what to do with the capital gain. And I think putting the money into opportunity zoning is a great idea. The only thing is that I don't know how to do that or what professional can actually help me setting up the corporation, because it's actually not a regular LLC. Like, it has to be set up properly before you buy or you put money into um, that land or corporation, because if not, it's not gonna work. I think that's how it is. That's what I want to find out.
Yeah, absolutely. Those are great Thanks for explaining that, Yanni. I really appreciate that. I think, I really start with like problem, consequence, solution. And so, dentistry is continuing to consolidate. So we're seeing a lot of dentists sell for that reason. Other people like you want to move. There's lots of reasons to sell the dental practice, but anytime you do, you typically have a two taxes. You have a capital gain tax and a depreciation recapture tax. Capital gain tax for active businesses that you're actively involved in is typically 20%, and if you're passive, typically 23.8. We'll see what if that changes this year, but that's where we're at. So, Danny, just want to make sure I understand correctly. When you sell your practice, you have depreciated things. You're going to sell for a certain number. You have like a capital gain tax that you're pretty aware of. Um,
Yes,
okay, great. And it's large enough that you're like, I don't want to pay this if I don't have to, right? Is
yes,
that okay? And so the other idea here is the number one, I try to go back to our fundamental concepts, and one of the fundamental concepts is interim taxation, right? So when you think of interim taxation, you need like not paying taxes. What do you think of? Like what's the impetus there? Why not just pay the tax, and like why do you want to not pay the tax or defer it?
I mean, you always have to pay taxes, but if you want to avoid paying a large sum of money, you know, if you can put that money actually into all the things that you enjoy, like real estate, why not do that? The only thing is that I've never learned how to do that. I think just because I'm still active in general dentistry, I cannot really um, deduct a lot of things from real estate. But I think capital gains, I can do that now. I don't know. That's what I'm not sure.
Yeah, you can. So let me share a little thing here that one of my key concepts that I like to share. Yanni, can you see this?
Yeah.
Okay. Oops. Let me shrink it back down again. This is big enough.
Yes.
Okay. So this is just a illustration to show you why not paying taxes in the interim, deferring or eliminating taxes is like the number one wealth accelerator. So in this first column here, you can see if you took $1 and you doubled it every year for 20 years with no taxes, you'd have $1 million. Okay.
Mm,
And if you paid a 15% tax rate on that doubling every year, you'd have only 220,000 after 20 years. And if you
mm,
paid a 37, you paid at the top of the tax right there, you'd only have 17,000 after 20 years. So how do you grow wealth? How do you have a how do you take your dollar and turn it into 1 million instead of 17,000? Is deferring and eliminating taxes, right? It's
mm,
what you make is super important, right? We know you got to earn enough income as a dentist to kind of get over the hump, but then after that, like getting free quicker, creating freedom quicker, building up your nest egg, all of that, a lot of that's heavily dependent on interim taxation. So, this is where we want to go, the million, not the 17. So that's kind of like the why, like why not just pay the tax, right? This is
mm.
the answer for that. So good.
Yes.
Okay. So next step here. So now we've talked about the problem, the capital gain tax, and we talked about the consequences. So let's talk solutions. What do you know about the benefits of opportunity zones? Annie, would you kind of explain to me in your own words how you understand it?
Opportunity zones is something that the government came up with. Um, I forgot the year. I don't know. It's something somewhere in 2010, between 2010 2018.
Yep. Yeah.
And
Yep.
they picked these areas because I guess at that point they thought that there were poor areas and they needed investors, people with a lot of money, to just kind of like grow and invest in these areas. Um, that's kind of like what I understand from opportunity zoning. And if you put money there and you leave it there for a while, then once you sell the property, you don't have to pay any taxes on the capital gains, right?
Yep. Yep. Absolutely.
But you
Uh,
have to leave it there for at least 5 or 10 years.
yep. That's great. Yeah, that's perfect. That's great. Yes. Yes. So in, it was either 2000, I think you're right. It was like 2017, I believe. Um, the administration at the time, was the Trump administration, wanted to, Republicans like to encourage private citizens to do what they think is best for everyone as a whole. And
Mhm.
so they look at these like lower income areas, right? In a city, picture, sometimes it's like, oh, the old stockyards just outside of downtown, right? It's kind of run down. Or maybe in Seattle, south of Seattle, there was this big area, and the city wanted redeveloped, and they were able to get like a stadium built there. Then all the little shops kind of built up around the stadium. They took old buildings and they gentrified them, made them apartments and retail down below, right? So you want to like revitalize an area. Well,
Mhm.
the best way to do that is usually to trigger tax incentives. And
Right.
so you're right. The how this one works is at the beginning you get to defer your capital gain tax. When it started, it was 7 years, but it had like a set date. So right now it's a 2-year deferral, which is great because every year is a new tax year, and every year there's new solutions to your taxes that year. So you kind of focus year by year. So this year, if you have a capital gain tax, um, you can take that gain. You don't have to take your basis. You don't have to take like the so you purchase something for a certain price, right?
Mhm.
And then you depreciate that, and what's remaining. So if you bought something for 1 million, you take depreciation on it. What's remaining, let's say 400,000, is your basis. Okay. So when you sell something again later for 2 million, you don't you don't pay tax on what hasn't been depreciated, that 400,000. You just pay tax on anything above that. So in that example, you buy for 1 million, you sell for 2 million, your basis is 400,000. You pay tax on that 1.6 million
Mhm.
at 20 to 23%. So instead of paying that tax, you get to defer it for a couple years and take that money and earn on it, right? And the
Mhm.
longer the deferral, the more time you earn on it. So that is one part of the opportunity zone benefit. It's not the biggest part though. And the Trump administration, they've stated many times, many people in the Trump administration, that they'd like to extend opportunity zones. They really like it. And the guy that kind of put this together the first time is now head of HUD. So he's got Trump's got the people who support it, who built it, who want to continue it. They've got a lot of things going on they'd like to do this year with their tax bill. So ideally they want to bring it back so it renews every year. So anytime you do an opportunity zone investment, there's a 7-year deferral, is what they'd like to do. If
Mm.
Yep. If they don't have time this year to do that, what they'd like to do at least is bump it from 2 years. Like it's like next 2 years, April would be when you'd have to pay those capital gains or find another solution for that year. But they'd like to at least add another 2 years to that. So their
Mm.
short-term solution would be to add another 2 years, but really they'd like to get it to the standard 7. Any questions on the first benefit?
No.
Okay. So yes, so it's only the gain, it's not your basis. Okay. You can invest your basis, but you don't get the benefits, the extra benefits from your basis. So now you take your gain and you put it into an opportunity zone fund, okay? And the fund then invests in opportunity zone businesses, which could be a business, an actual business that operates in an opportunity zone, or in a real estate. And mostly it's real estate, but there are quite a few businesses as well that have done this. So how did this happen? So when they created this in, I think, like I said, 2017, the federal government went to each of like the governors and said, okay, pick the places in your state, right, that you want to lift up. And so oftentimes it was lower income tracts, like you mentioned. But sometimes, like almost all of downtown Portland was 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 made an opportunity zone because they wanted to like really funnel investment dollars into downtown.
It wasn't a strategy.
Yeah, so I think
They
it's
liked the area and they wanted money in the area.
so where you want to move, it sounds like the governor of Florida at that time, or whoever he appointed to kind of figure this out, said, hey, this would be a great area for us to develop. Let's make this an opportunity zone.
Mm.
Good.
Mm.
Okay, so that's primary benefit number one. You put the capital gain in there, and kind of people ask me like when do I have to get it in there? Okay. The typical answer is within 180 days from when you sell. Okay, that's the most common answer. But there are loopholes to that. So actually, if you sold out of a partnership, like say you and your husband own the practice together, or an S corp, which many dentists do, you actually have, like, let's say you sold last year, January 1st. You
Mhm.
would actually have till around September 10th of this year to move your capital gain money. So if you're a dentist out there and um so yeah, so if you're a dentist out there and you sold your practice last year and you've deferred your taxes payments, and so you still have, a few more months till September to pay them, you can actually put your money into an opportunity fund now and not pay those capital gain taxes.
Mm.
Make sense? So most people are like, oh man, I have 180 days. As corporate partnership, you actually have from January 1st to last year. So it creates a lot of freedom and flexibility for us. So
So it's like 19 month.
it's really not so much the months, it's the partnership or S corp, and then it's it's like 180 days from your deferral time, which is like March 15th. So like 180 days from March 15th is like usually around September 10th. So
Okay, okay. Mhm.
it's like around September 10th of the following year. Okay. So
Mhm.
like, I transitioned some of my practices last year. I had 6 practices. I transitioned them to a wonderful, wonderful group. And so, I created an opportunity zone fund. Um, that I put a lot of funds of myself in there, and then a lot of my colleagues, same thing, right? Like I
Mhm.
said, there's a consolidation of dentistry, so like half my buddies have brought on partners to take over those practices, right? And so they're having these equity events, and then we're also having recap events, right?
Mhm.
So if you have like $1 million EBITDA practice, sell it at an 8x valuation, right? You're getting like $4 million last year, and then at recap maybe another $4 million, right? And these create major tax problems for me and my friends and my investors. And so what we do is we take the capital gain piece and we put it in these opportunity zone funds, just like you're talking about doing, and then I take that fund and we'll get to this next piece, but you basically either build buildings or you redevelop existing buildings, and we'll get to that. Okay, so it's hard to keep it simple, but
Yeah.
okay. The bigger benefit here, though, that we haven't talked about. So that's one benefit, but the bigger benefit is when you invest in real estate, right? Like average return stock market, whatever you want to call it, 8 to 10%, net of, let's say, 4% inflation. We can talk about why 4%, but like your net return, let's say, is like 4 to 6%. Okay, we even use the high number, 6%. Real estate long term, like real estate, when you look at income, depreciation, equity pay down, appreciation, interest expense, tax benefit, you're typically talking long term about a 16% return. Minus 4% inflation equals a 12% net return. So real estate, 12% net return, stocks, 4 to 6%, right? So 2 to 3 times as much long term. We can dive into that on another video if somebody wants. We always dive into that one. But the idea here is now you are taking this capital gain money, not paying taxes on it, investing in this real estate, and in opportunity zones, you got to hold it in there for 10 years. Well, on average in a solid project, you're getting a 16% over that. Expenses and stuff, but pre-expense. And then at the end, just like with any real estate or any dental practice, you need to pay capital gain tax, you need to pay depreciation recapture tax. Are you familiar with depreciation recapture tax?
No.
Okay. So this is the other big tax that people aren't aware of as much. So we talked about capital gain. If you're investing in real estate actively, it's 20%, passively 23.8%. Okay. That's a major ding, right? Because if you're taking, whatever the number is, let's say $1 million, I think $1 million is the common number here on these investments. So in my opportunity zone fund that put in $1 million, I'd like to see it at 2.5 to 4 million for my investors after 10 years. Okay. Well, now let's say it's whatever, 4 million for easy math. Let's say it's 4 million, right? And we sell. Well, the capital gain piece on a passive for them is going to be 23.8, right? So that's like $1 million in taxes right there. And then what's great about real estate, as is you can depreciate it, right? So when we build these buildings, we depreciate the heck out of them so to take down our taxes, right, in the interim. Okay. And we also, another thing we'll talk about more is we often refi. Okay. So if you do build something, right, add value to it, increase the value, then you refi, pull cash out, that's tax free. So that's a great way to pay that capital gain tax that's deferred. Because remember, the original capital gain on your dental practice is going to be deferred, 2 years right now. Trump administration is trying to push it to 4 to 7 years. A great way with real estate to pay that tax is to build whatever you're going to build or redevelop and then refi, cash out and pay that tax.
Oh.
Or use other tax solutions that year, which we can talk more about. Good?
Yes.
Okay, slow me down. I apologize. I know I get going. Okay. So so we have I think for simple math, we use 4 million. Okay. You have your $4 million gain in 10 years from now, right? Got to hold the property for 10 years. Now we're selling, here's 4 million bucks. So you got to pay depreciation, you got to pay capital gain tax, typically 23.8%, and then depreciation recapture. So Trump administration is also about bonus depreciation, right? Which allows us to do cost segregations and really depreciate a property fast, right? That way you're not paying taxes passively. On average, let's say 3 to 4 years, you don't pay taxes on any kind of related investment like real estate. Okay. So, but let's say we depreciated that building a lot. Let's say we've depreciated 3 million of that building. Okay. So your gain, man, I got to keep it simple because this is not all exactly accurate. I have to put in a spreadsheet to show you, but that gain, that 3 million, depreciation recapture tax is typically on real estate 25%. Okay. So you're not only paying 23.8 capital gain, you're paying 25% of that 3 million. Okay. So your real tax on stuff when you sell is more like 40%.
Wow.
So you're paying like 40% of 4 million, 1.6 million of taxes. Okay. So with a 1031, it's a common strategy. You got 180 days. It's kind of like having a gun to your head. know if you've been in one. I've been in a couple, and you got to like sell a property, find the next property to roll the money into, right? The debt and the equity, so you don't pay those, right?
Mm.
Um, what's amazing about an opportunity zone, instead of having an 188 window, like a 1031, the capital gain tax on your building that you sell in 10 years within the fund or the fund sales and your depreciation recapture. No tax on either. The best analogy would be having like a Roth. Okay.
Hmm.
So, your original million people, we want to defer those taxes. Absolutely. Right. Earn money on that, defer that 200 grand in taxes. Nice benefit. Okay. But the real benefit, like I said, is at the end when you sell, now you're avoiding 1.6 million in tax. So if you
Wait,
have,
wait.
yeah, go for
Let
it.
me just put it in simple words. Let me see if
Yes,
I understand, okay? Yeah, because I see you're very good at this, but it's like like you understand everything, but I don't understand anything.
please slow down,
Okay,
slow me down, ask
yeah.
questions.
Okay, so simple number 1 million. Okay, so I depreciated everything over the last 10 years. So if I sell for 1 million, then I have to pay 200,000, right?
It depends how much you depreciate. It's usually not 100% depreciation, right? There's usually some basis left, like 20, 30%. So you're usually paying capital gain on like 700,000 or 800,000, something like that. Just depends what you and your accountant did.
Okay, but imagine it's 200,000.
Okay.
Okay, so 200,000. Then I don't want to pay 200,000.
Yep.
I just want to put the million or the 1.2 million or the 1.3 million, or whatever money it is, into an opportunity zoning. All right. So I see a piece of land that is located in opportunity zoning, and I say, hey, let me just build from scratch. And then I buy the land for 80,000, right? And then I build, for example, I don't know, 500,000, 800, no, yeah, 500,000, for example. So that right there, for example, is like 600,000 that I put money there. And then immediately after I build, that location is worth $1 million. But I don't want to sell right away. Imagine if I keep it. If I keep it, and then I refi, what you're saying, right? If I refi, the bank will look at the appraisal amount, which is 1 million, right? And they would return 750. They would give me 750 cash, right? Because they usually keep 25%.
Yeah. Yep. It's based off
Okay.
debt service coverage ratio, but yep. That's
Okay, so the cash money that I put there, it was like 600,000, and then I get back 750. And what you're saying is,
keep going.
okay, what you're saying is that out of the 750, I take out 200,000 and just pay the capital gain so that the rest of the money is mine. So now I have a property and I pay taxes, so I'm free.
Yep.
Is that what you're saying?
Yep. Except
Okay.
the amount of money yes, everything you're saying is correct. With opportunity zones, you need to put in, depending on how it's structured. In your case, it's going to be 70% improvement. So,
But
how
when you
can I-
build, you're doing
you
100% improvement, right?
well, like the land value. So, like your land value of
80,000,
if
no,
you own that
80,000.
already, right? You just need 80 to be like 30% of the value, and yours is going to be fine, right? But I think the piece you're missing here is leverage. So when you're building stuff, typically you take out construction loans, right? To do that. So the numbers you should be kind of thinking about are maybe 3 times the numbers that you just mentioned. So instead of thinking one property, think 3 properties. with that cash that you're bringing from your dental sale.
I get confused. But if I have the cash, do I still have to go through the bank? No, I can just put that cash into building the land and then I refi.
Yes, if you wanted to go just cash, you could just do that. Yep.
Yeah, but only if I refi, I can recapture the money. If I just leave the money there, I I wouldn't be able to pay capital gains.
You'd have to have the money, you'd have to get the monies from somewhere else, right? From your income as a dentist or something. Yep.
Okay, but the capital gains, I have 2 years to pay it.
Two with the current law, and they're looking to extend it 4 to 7 years. To 4 years or temporarily, but ideally they want it at 7.
Okay, but okay, so there are two, from what I understand, there are two benefits right now. So one is just literally deferring the capital gain tax that I have to pay. So the
Yep.
200,000, instead of paying it next year, I have 2 years and possibly more years to pay it back. And but the biggest benefit that I see, that I think I understand, that I see, is that once I build that building, if I keep it for a certain amount of years, if I sell it afterwards, I don't have to pay any money on the capital gains.
And the depreciation recapture.
So that would be like free money. I'm putting money in there that I don't see, but once I sell, I will see a lot of money, right?
Well, if you
It's like
are
a Roth. You
successful
said that
with
it's
your
similar like a Roth, right?
what was the last part?
You said that it's the analogy is the Roth. It's like having a Roth.
The analogies is the Roth. So it's about a 40% boost to your return by not paying capital gain and depreciation recapture tax.
So that would you consider that the best real estate investment right now? Because if you buy something different, not in an opportunity zone, if you sell it after 10 years, you still have to pay capital gain on whatever value you added there, right?
Yeah.
So
So this
it's like a traditional, not a Roth, but a traditional.
it's more like
So
a Roth.
Roth 401k and then traditional 401k.
It's more like a Roth.
Yeah, the Roth will be the opportunity zoning,
Yep.
but just a regular building that you buy or regular land that you build, it would be just like a traditional. You still have to pay later on
And
capital gain.
well, yeah, and you got to pay it early too. You got to pay both. So it's not really
Oh,
like a
okay.
traditional, but yes. So what I tell people, Yanni, so like I said, a lot of my buddies have been consolidating, selling their practices the last,
Mhm.
3, 4 years. And what I tell them is, when you have a capital gain, if you like, and if you're planning on investing in real estate anyways,
Mhm.
and you are comfortable with development or redevelopments in real estate, then there is no better tax structure incentive out there than opportunity zone funds.
No, it's actually kind of beautiful.
It's very beautiful.
It's interesting.
Absolutely.
It's
Uh,
yeah.
all of I would say about half of my developments are in opportunity zones now because of this. It's really, really nice.
Mm.
So, I mean, it's going to be a massive wealth builder. Like when a dentist has how old are you, Yini, if you don't mind me asking?
35.
35. Okay, young. So typically when someone sells their practice, right, that's their number one like wealth building event of their life.
Mhm.
You're earning income each year, but like this is the largest like single event.
Mhm.
And so taking that largest single event, deferring the taxes so you can earn on top of that, right? And then
Mhm.
compounding it within real estate for 10 years, two and a half, 4 times the value, then not paying any tax, right? Like doing a Roth with it, basically, right? Like
Mhm.
there's no better like wealth accelerator than this, in my opinion. And so that's why, we do so many of these. So
Okay, I do have another question. Um, okay. So can I convert an existing LLC? So right now I do have an LLC and I do own land in opportunity zoning, but under my name. So if I switch the land into an LLC, wait, the first question, can I convert an existing LLC that is supposedly to be for real estate into an opportunity zone corp? Because I think opportunity zone cannot be an LLC.
So there's a couple different entities typically. Okay, there's an opportunity zone fund at the
Mm-hmm,
top, and this is
mm-hmm,
not the only way to do it, but this is the typical way to do it. And then
mm-hmm.
there's LLCs. And then the fund invests in LLCs called opportunity zone businesses. Okay. What you have here is a opportunity zone business, right? This land that you own. Okay. You can contribute it or use it as an opportunity zone business because you're a related party. Like they wanted to incentivize people to go do this. They didn't want to like give this award to people who are already in opportunity zones. Okay.
Mm-hmm. Yeah.
So there's some tests that happen every 6 months. And one of those tests is like, is this a related party or not? So yours is a related party, but it's such a small value compared to what you're going to create on that land.
Yeah.
Okay. So it just has to be less than, it has to be 30% or less of the total like money you put in the related party land. Um, Make sense?
Yeah.
Okay. Um, yeah.
Okay. Okay. And then I'm actually under contract with a commercial building with tenants, and it's located in opportunity zone. But I haven't created a corporation to buy this building because I wasn't sure if I have to do something differently when I create the corporation versus just a regular LLC. The only
You
thing is
do.
that,
The legal verbiage and whatnot needs to be. So, but you don't really finalize that stuff till the end of the year. So as long as you get that done, before the end of the year, you're usually okay.
so I can just buy it using a regular LLC that I have, and before the end of the year, I can make the proper arrangements to do whatever
Typically,
I need to do.
not an attorney, not an accountant, but typically, yes. Okay.
Kind of that way. And then, but like if you buy an existing building, I've seen that you have to put at least double the money or whatever is costing you. Whatever costs the building right now, you have to put that kind of money into the building so that it works.
So typically, when you're buying a building with tenants, okay,
Hmm.
you're not doing a massive value adds unless, so that wouldn't typically work.
Yes,
Okay.
yes.
Now, if you buy like a building with like one tenant, right, and the rest of it's empty, and you're like making that thing like way nicer, right? You buy it for, $100 per square foot, and you're putting another $100 per square foot into it to make the building nicer, do tenant improvements, which they often ask for, right? $30 to $50 a square foot. So there's a good way to put that money in. Another good way is if it has extra land, right? If you're buying a shopping center and there's the parking lot's big, you can put retail, you can put pads in the front, right? And build buildings there. So yeah, as a rule of thumb, just double is a good way to look at it. And so usually you're buying kind of like rundown buildings, fixing them up, or doing ground up construction to meet these redevelopment requirements.
Okay.
This one may not qualify unless you got extra land on there.
Yeah. So it's just easier to just buy land and just build in there.
Land, or let me give you an example. So, um, the one right now that I have, it's land. Okay, we're gonna do. I think we bought the land for like, I don't remember on that one, but we're going to do probably like a $25 million apartment development. Okay. So the land is probably, at first, maybe a tenth of the value. And once they get through entitlements, maybe like 25% of the value or something. Okay.
Mhm.
So, most of it is the building, right? And so that qualifies. But once I get a little time, I have my eye on quite a few buildings. Okay. So if you like around my area, it's like downtown and then kind of around that, often is a little bit lower income because people don't usually have like nice homes next to downtown, depending on the area.
Mhm.
So let me give you an example. So it's kind of paint the picture, a story. So somebody took like the old railroad tracks right above the river and made a beautiful community. Okay, in my hometown called Kendall Yards. There are mixed use shops, right? There's the pizza place, there's the nice wine bar, there's the nice Mexican restaurant, there's the ice cream shop, the breakfast brunch place,
Mhm.
right? And then they have multifamily apartments, and then they have homes, and then they have like townhomes. This big, beautiful development. Okay.
Mhm.
But the area around it's still poor. And there
Mhm.
are some older commercial buildings. So a church right now has an older mixed use. It's probably 12 apartments above, brick, beautiful, 12 apartments above with empty shop retail on the bottom floor.
Mhm.
Okay. They might have this listed for, I have to check on this one. They might have this listed for like 150 square foot. Okay.
Mhm.
It's empty. It's been empty. There might be apartments living in there, but they're like lower level,
Oh.
like not good rent apartments, kind of run down. And then the retail's empty. Okay. So the lowest I've seen, those kind of empty buildings that are just empty. There's nothing to them. Old buildings around here with no parking, like downtown, no parking lot, just empty. I saw one sell a couple weeks ago for $17 a square foot. Okay.
Wow.
So that's pretty low. But let's say I can get this building for $100 a square foot. Okay. If I'm
Mhm.
if I'm building from scratch right now, not brick, but just building like a fiber cement wood frame
Mhm.
building, I'm probably at 200 a square foot, at least, right? So I know like I'm buying for 100, I'm going to be putting at least 100 into this, right? Make all these
Mhm.
apartments nice, update them, plumbing, electrical, whatever we got to do. Put in a beautiful storefront in the bottom, bring in some nice shops, right? So I
Mhm.
know that's going to qualify. Is that a good example?
Yeah.
1950s brick,
Yeah.
like
It's just finding the right opportunity, like some, like,
and and most people, right, they see these rundown buildings, right? And they're like, wow, it'd be cool to like update that, right? And so now we have a program that allows us to do that. Another program that you can stack on top of this is the historic tax credits if it's an older building.
okay.
So what you do like in development, so what I do is like I find something that works. Like I have a vision, right? Like this would be really cool right here, right? Like you have to know that the people will want it, right? Your customer.
Yeah.
So if you have the vision, and then excuse me, now I just start with opportunity zone. So I just go, okay, here are the opportunity zone. What are the buildings within the opportunity zone? Which one of these can I turn into something really cool?
Mhm.
And then when I find something I can turn into really cool, then I'm like, okay, how many tax credits can I stack on this? Right. So I do the opportunity zone, which I already mentioned. Then I try for historic tax credits. And then I also try for things like we have a multifamily tax exemption here where you don't have to pay taxes on the apartment buildings, just the land, but not the apartments themselves for 12 years. As long as you don't charge rents higher than like 80% of like average medium income in the area. Well, market rent is like at 80% or actually like a little below it. So you can stack tax credits that don't even hurt your development. Make sense? Like take what the government's giving you that's incentivizing you and really stack these to maximize long-term returns for your investors and yourself.
But that's not Section 8, right?
No. So okay. So no.
Okay. Okay. Just wondering because I think they're
So
There are
Section 8,
incentives when you build for Section 8, right?
yeah, so there's so many different programs. I have another project I'm doing, which is affordable housing. Okay. Those still aren't Section 8, but I'll give you some examples of the difference. So one is just you can't charge rents higher than this. Okay,
Mm-hmm.
for a certain number of the units. For that multifamily tax exemption, I think it's only 20% of the units. Okay, so if I'm building a 30 unit apartment building, it's like 6 of them have to be right. And it doesn't actually hurt me because I wouldn't charge more than that for rent anyways. Okay.
Mm-hmm.
But other ones, like I'm applying for a couple grants right now, like literally they're due Monday. Okay. I'm applying for a $2 million grant and a $1 million grant. The $2 million grant is to build apartments. I think we're building 24 apartment units. Okay. In one of the buildings, 6 of those units are going to be for like families that are at risk for homelessness. Okay. The max I can charge them is 60%. This is like, if you look in California, this is required for like every, well, it's not exactly like this, but when you talk to like developers in LA, they like make you do this. Okay. This is, if you want to build market rate, you have to do this every time. A certain percentage of them have to be at like 60% or less of AMI. Okay. But what the government does is they'll provide, let's say, on this one, maybe 10 units, maybe 2 million, $200,000 per unit. Okay.
Oh,
Yes,
wow.
you're only charging 60%. If 80% is like market, you're charging like 75% of market. Okay. They're getting 25% discount. And it's got to be like a target population that the government cares about, whoever, if it's a municipality, the state, or whatever. But now I get like an extra 200 grand to build each of those units. They're giving me money to build those units. Sometimes it's a grant, sometimes it's a long-term loan, like a 1% loan for 40
Wow.
years, and I don't even start paying it for 10 years, paying on it for 10 years. Make sense?
Yeah.
So it's not, and that's not Section 8. Section 8's different. So that's like what you can do is you can start getting vouchers from your local housing authority to like supplement the difference between what the tenants are paying, the lower income tenants, and like a number that the government comes up with, right? So they'll pay you like a few hundred extra bucks or whatever a month to house as well. Okay.
Mm.
And when people say Section 8, that's the challenge is if yours really getting down there, let's say 30% of AMI. Okay. So if your AMI in your area is like 100% average income, okay, medium income, or what, I'll use 100 for the simplest, like 30% of AMI is like people are only making 30 grand a year. Right.
Mhm.
And if you have people who are making 30 grand a year, you know, not all people making 30 grand, but a higher percentage of them struggle in life, right? If they struggle in life with mental health, other challenges, right? That creates Section 8 housing where you have this like a stereotypical, like not, more challenging tenants. Okay.
Yeah. Yeah.
But I guess last point is typically when you're trying to, like, I do a lot of projects that are market rate. Let's say 80% of my projects are market rate.
Mm.
20% affordable because I want to do cool things, right? Do good while you're doing good, right? And so I'll build these infill affordable places, but we don't have like all the tenants at low incomes. Okay. We try to create like a diversified community. So 75% of these units are going to be market rate,
Mm.
right? And then 6 are going to be like families that are at home at risk for homelessness. And then 4 of the units are going to be probably like veterans with like disabilities, right?
Mm.
So you're creating these diversified um, communities.
Yeah.
What other questions you got, Yanni? You're doing great. Yeah,
I mean, the multifamily tax exception, is that something only in your state? I've never heard of that before.
every state has it different. Texas is like the biggest multifamily state, right? Because it's huge and everyone's moving there. Florida's up there too. And I know Texas has their own versions that I've seen on many deals. I'm most familiar with the Washington ones, but yeah, a lot of states. States just have different incentives, so you just got to figure out what those are, right? Just like the federal government incentivizes you with tax rebates or deductions to do the things they want you to do that are going to benefit society. Same thing with the state. So you just got to figure out what those are, and then when you can build those in, and it changes. Are you familiar with like LIHTC?
No.
LIHTC's like a big program that's it's very complicated. I won't get into it, but like more affordable housing, that's what they did for decades. Certain states it still works. In Washington, it doesn't really work anymore. It's really hard to get, and
Mm.
it's just the numbers don't really work. It's not really worth it. But like, 5 years ago, for like the previous 10 years, I believe, I don't know when LIHTC started in Washington, but like there were a ton of LIHTC stuff. Like developers were just doing a ton of affordable housing because the incentive just worked. So I think that's why I'm excited about the new tax bill coming, this year and then next year too. Um, the Trump administration is going to put a lot of incentives in.
Mhm.
They want to spur certain things, right? They're big into housing. And so like HUD is going to continue to create like real incentives for folks to create affordable housing. And if you read the tax bill, figure out what those are, just like opportunity zones, and you take advantage of them. I mean, there's, I mean, this, Yanni, like you're very entrepreneurial to be at 35 already doing this.
Mm.
Very impressive to build a good practice and do the real estate. But 95% of dentists, this is why I tell people not to do a second practice, right? It's either grow your first practice large or go to 30, but don't do like two, right? Because you're diluting your energy, right? If you're the secret sauce, you're diluting your energy. So,
Mm.
um, most dentists don't have the energy, the bandwidth, the passion to grow their practice and maximize that and be a great, wife, mother, right?
Mm.
Uh, and do all the real estate stuff and be good at it, right? And so, um, yeah, so if you can do that, that's very impressive.
Thank you.
Yeah.
So as far as the hood, do you usually apply for grants using the hood for the
Uh,
affordable housing?
what do I like HUD most for? So
No.
grant
The,
HUD backs a lot of the federal incentive stuff, but usually the money goes to like the state or the city, and then you get the money from the state or the city. So yeah. So for HUD, so HUD is behind a lot of the programs in my state, but I don't work directly with HUD on those.
oh, okay.
The only place I work directly with HUD on are lending. So HUD loans are the granddaddy of loans. So if I build a multifamily building, right? I won't get into that. But if I build a multifamily building, when I'm stable, I build it, I get it filled up with tenants, right? And then I refi it because now it's worth a lot more, right? Because the building's finished and it's full of tenants.
Mm-hmm.
The best loan is a HUD 223F. Okay. What it is instead, I think on the 223F, I think it's 35 years. Okay. So most commercial loans, are like 25 years, right? So this is a 35 year. Most commercial loans are 5 year fixed, maybe seven, maybe 10, depending on what you ask for, but 5 year fixed, and they mature usually at 10. The HUD loans are 35-year fixed. Okay. So
Wow. Mm.
it's amazing, right? And their interest rates are usually the lowest. So it takes a little more work to get through the administration piece, but like I can literally build a building, refi out 80% of the value, and by that time that's basically all the money I put in and maybe more, right?
Mhm.
That for our investors. So we build it, refi it, give cash to our investors, and then now we lock in this rate and for 35 years. And every year, right, expenses go up, but rents go up more, right? When you look at an apartment building, let's say 2/3 of its revenue, well, if you look at the revenue, 2/3 of it well, cost is 1/3, which means like retained revenue is 2/3. Okay. So if
Mm-hmm.
your retained revenue is 2/3, your costs are only 1/3. If you apply like a 3% compounder, the 2/3 is going to get much larger than the 1/3, right? So if you can lock in those rates, that's why like, old 70-year-olds that own apartment buildings are rich. They lock in those rates. Costs don't go up as fast as their 2/3 piece, right? And
Yeah.
so that's the way to really build wealth. That is like the way to do it. So I use HUD for that. You can also do HUD on development. They have like a 40-year product for that, which is really good as well. It's just a lot of paperwork, and
Mm.
there's some other things like you don't really want to do 4-story buildings, only 3 or less, because you got to pay Davis Bacon wages for commercial if you go 4 stories or more. Too much details. Trying to stay focused here. Okay, so our goal today was to answer your questions about
Yeah.
opportunity zones, like the background, the why, how they benefit others, and how they're the number one. If you like real estate investing and you have a capital gain, there's no better structure out there. Any other final questions you have for our audience?
No, no.
Okay, Annie. Well, it was great having you on the show today. Everyone else, thanks for tuning in to the Dr. Josh Cochran Show. Wealth, health, family, freedom. This year, commit to building the future you deserve.
All right. Thank you.
Yes, Jenny, feel free to reach out anytime. I just like this. This is more fun for me than doing Facebook. It's just more connection, and we really got to talk stuff through. So thanks for being brave and hopping on today.
Yeah, of course. Thank you. Thank you. Thank you for your time.
My pleasure. Take care. Bye.
Yes.